well, rates are not quite as low as I want them to be. What about that 30, 40 grand incentive you were talking about? Like, haha, not available anymore because they don't need it because everybody's buying homes in the spring. All right, so I've got Brian Jacobs on today. Some very important information coming at people. We're about going into Thanksgiving holidays. Then we have Christmas, not exactly the buying season. But the good news is rates have been going down. And so Brian Jacobs, my local lender, also preferred lender of quite a few builders here in town, done a lot of business with him. I'm going to pick his brain today and get some good information for all my folks out there that are thinking, hey, this is not a great time to buy. On the contrary, the opposite. I'm not just a salesman telling you that. I'm actually seeking another investment property for ourselves as well. And so my motto is be fearful when others are greedy and be greedy when others are fearful. And so right now, not a lot of people are out looking for homes due to the holidays. They're not fully educated on what's going on with rates and what's available out there. And so it's our job to educate people if you need a home and really figure out what your circumstances are. So Brian Jacobs, welcome.
Thank you. Thanks for having me.
Yeah, absolutely. Of course. Hey, really quick, if you don't mind, would you just tap that subscribe bell, especially if you've been watching my videos and you see value in them? It really helped me a great deal. So lately, I wanted to bring you on because lately I'm seeing a ton of incentives by builders. We're going into the holiday season. This is always when sales are a little bit down. And that's where builders are like, hey, we really need to start marketing because there's a lot of inventory homes, spec homes have been built that are going to be done soon. Some builders, it's end of the year. And so there's a lot of massive incentives out there. Some of the local builders that you and I work with, I've seen 30, 40, 50 grand of additional incentives. And I always tell my audience, you cannot negotiate the price of the home down because that would affect the comps for future sales. But you can work deals with additional incentives. And so what I'm hearing a lot lately is about the 3-2-1 buy down. So can you give us a little idea, as simple as possible, what that product is and why is it so popular right now?
Yeah, absolutely. So yeah, the elephant in the room, literally for the past year, at least year and a half, has been rates. Rates have been on the rise. They are not necessarily historic highs, but they are a lot higher than coming out of the pandemic, where we saw the 2s and 3s. And for a minute there, they were pushing every bit of 8%. And so that's clearly a sticker shock when you run the math between a 3% rate and an 8. Your buying power is just going way down. And so, Greg had mentioned the 3-2-1 buy down. So there's actually 3 different types of buy downs, and these are what's considered a temporary buy down. And so for example, the 3-2-1 buy down. So let's just say the current rate is 7.5. So for year 1, it's going to be 3% lower. So we got 6, 5, we got 4.5 for year 1. And then year 2, it jumps up to 5.5. And then year 3, it goes to 6.5, and then back to 7 starting year 4, or the 7.5 starting year 4. So these builder incentives that Greg was talking about is that could be used to do that. And so essentially what's happening is that the builder's kind of supplementing your payment. And so it's going to help you kind of ease into eventually that 7.5 payment. However, the theory behind this is that rates aren't going to stay where they are forever, and then you would probably have a refinance opportunity within the next 2-3 years, if not sooner. So it does help. It defers a lot of that interest, and then you can have a more manageable payment. The beauty to these things too is that, let's just say we go a year and rates magically come down and they're at 5%. Well, that's probably a very good time to refinance. you're not going to lose all this money that you've prepaid now for the 3 years. So we actually will give you a credit back on your payoff for any unused balance of this subsidized payment from the builder.
Okay. Is this money held in escrow or by the bank, or how does that work?
Essentially, yes. It's like an escrow account. You can think of it. And so, so whatever remaining balance is in there when you refinance, like if you owed 300,000 on your payoff and there's $5,000 left, we would reduce it to 295.
Okay. And so let's say the rates do go down, and you refinance, you get credited unused money. But let's say you use the full 3 years, it automatically goes back to 7.5%, or does it go to whatever the current rate is, the prime?
You know, it would go back to the initial locked-in rate. So 7.5 is your base rate. So it's just a 30-year fixed loan at that point. And
I got
you just have 27 more years to go. So.
But you do have to be pre-qualified to be able to pay the 7.5 rate, even though the first 3 years it's being bought down. Is that correct?
That's right. So everyone's scenario is a little bit different. Down payment, credit scores, loan type, all these factors go into this. So, you know, someone may have a higher credit score and qualify for a lower rate. Well, that's the rate they would start with. Whereas if their credit score wasn't as high, or whatever their dynamics were of their loan, maybe their credit score would be a little bit higher, but that would be your starting rate. And then from there, it would take that 3 year or 3% down, 2%, 1%.
Okay. And that's pretty popular because I think a lot of people are thinking, hey, this is going to take a while before rates go down. So I feel like 3 is the magic number right now. That gives you a little leeway to see where things are going. Although I'm super optimistic and bullish for next year, mid to later next year, a lot of people are a little more conservative. Are there other buy downs that people are doing as well right now besides the 3-2-1?
Yeah, so the 3-2-1 is by far the most aggressive, and not every program is going to allow it. So if you had a 5% down payment, it wouldn't be an option, because there's this might be a little more higher level, but there's certain amounts that the seller can pay, and if you only put 5% down, it's not going to hit the max, if you will, where you can actually take advantage of the 3-2-1. But if that's the case, you could do the 2-1 buy down. And the 2-1 is the same principle. It's 2% lower the first year, 1% the next, and then back to the initial rate. It's significantly less expensive to do that. So when we're looking at these builder incentives, or any incentive for that matter, we'll have to kind of take a look at the cost of it too, because I mean, it can, that's a lot of interest, 3 years worth of interest to defer. So there's the 2-1, and then there's also what's called a 1-1, where it's a 1 year kind of a buy down, where it's 1% lower the first year.
Okay. So yeah, so it's important to understand that there's also a limit of what, if there is a builder incentive, there's a limit of what they can contribute based on what the ratio of the loan is and whatnot, right? So on these 3-2-1s, are most of the people putting 10, 20% down, or at least 20% down?
Yeah, so 10% would be the trigger. So at 10% down, and this is so for a conventional loan, one that would go to like a Fannie Mae, or I'm sure you've heard of those kind of secondary markets. But that, once you hit 10% down, the seller can pay up to 6% seller contributions, and that's 6% of your sale price. So, yep. So in that case, it would qualify for all of those, because generally the cost of a 3-2-1 buy down is somewhere around 5.75% as a contribution. So it would take every bit of that. Whereas on a 2-1 buy down, generally you're at about 2.75, 2.6 or so as a cost. So it's 2.6% of the sale price would be approximately what that cost would be.
Okay. Can we do a scenario? Let's say, is that going to be too tricky right now on the spot?
That'd be pretty easy.
What would be a good example? Like I see right now locally here in Nocti, we have a local builder that's offering pretty decent size incentives. So let's say you wanted to buy, I was going to say 650 because that's pretty common, but let's just make it 700 to keep it easy. Would that be a better idea? Okay, so let's just say I want to buy a home for 700 grand. Let's say there's a $30,000 incentive that I can do whatever I want with it. What would be the best case scenario for this deal to work? Like, what would you advise me?
Sure. What down payment would you want to use on?
Let's just say I'm putting 20% down.
Okay.
Yeah, let's just do standard conventional 20% down.
Okay. All right. So, and if we had 35,000 to work with.
I said 30.
No, I'm sorry, 30. Let's do 30. So at 30,000, so we can kind of, so a lot of the builders are using this as kind of like a flex cash kind of thing. So you could not necessarily, wouldn't have to use it towards a buy down. You could use it for some of the buy down, and then you could use it for your closing costs. Because that's, on a new construction home at 700, I mean, just ballpark, you're probably 20 to 22, 23,000 for that. So, and it depends on community.
Okay, so let's say I say, all right, Brian, I want to go ahead and wipe out those closing costs. I still have maybe 10 grand to work with. What should I do with that remainder 10,000? The rates are a little high right now. It's 7.5. I wouldn't mind buying it down to 6.5 at least. How would you advise me on that?
So
not guide me or not, or, give me some ideas of what would be the best case scenario. Putting 20% down. You usually on a new home construction, we say your closing costs, rough guesstimate ballpark is what, 2-3% closing costs?
I'd say about right. Yeah.
Okay. So I have a little bit of money left over. What should I do with it?
Yep. So, so if we take the full 30,000, we take out the closing costs, that leaves us 10. So the conversation then becomes, okay, let's look at the different temporary buy downs. So for example, if we were going to do the 2-1 buy down, the cost on that would be about 13,000 based on what I see. So, okay, maybe we just not get all the closing costs paid, but we use 13,000 of it first, buy the rate down, and then you're on the hook for 3,000 of your own closing costs. But what that does, year one, you would save $730 a month on your mortgage payment.
Ooh.
Pretty good.
Yeah.
Yep. And then year two, you would save, it says 372 per month. And then year three, it goes back to the full payment. And so, which would be in this scenario about 3,800.
Okay.
So, so that's one option I would advise. And then the other option, it really just depends on where the rate is at the time and how far that 10,000 can go, because we've only talked about temporary buy downs at this point, but there's also permanent buy downs. And the common term in the industry is paying points to buy your rate down. And 1 point, which means it's 1% of your loan amount. So if you're in this scenario we're talking about, if it's $560,000 loan, that's 5,600 would be 1 point. 1 point generally will lower your rate anywhere from 1/4 to 0.5%. So if we're at 7.5, 1 point could lower you to 7. Well, if we've got 10,000 to work with, maybe we have 2 or maybe a little more than 2 points. Where we could buy the rate down permanently to a point where even if rates do come down in the next couple of years, you may not need to refinance. It might get to the point where, okay, maybe we bought it down to 6.5 and rates are only at 6. Well, it might not make sense for you to go to the cost and refinance. So that's a conversation that we always have too, kind of big picture things. Now, in my opinion, doing if rates were back to where they were up at like 8%, and we're buying it down to 7.25%, you're probably going to refinance either one of those in the next couple of years when they do come down to hopefully in the fives. So I would probably recommend the temporary buy down at that point. So it's all, I mean, it's very customizable. It's very much what means the most or helps you the most as a buyer.
Yeah. So everybody's case scenario is different. So that's why it's so important to call someone you can trust, a lender. That's why I use Brian all the time, so that he can talk you, answer, if you can answer the right questions to give them the perfect picture of your scenario, then, we can figure out what's the best loan for you for your situation, because at least there's different options out there. And I will tell people boldly that come February, as early as February, March, again, people are going to start ringing the phone like crazy. My early people call me in the end of January, and then the second early people call in February, and then I have my late comers in March, April, May. And they're going to be like, well, rates are not quite as low as I want them to be. What about that 30, 40 grand incentive you were talking about? Like, haha, not available anymore, because they don't need it, because everybody's buying homes in the spring. I always say the best time to buy a home is the day after Thanksgiving and the day after January 1st. The reason is because everybody's full of turkey the day after Thanksgiving, and they're with family, and they're not looking to buy a house. And the day after New Year's is, again, people are broke after the holidays, and they're not looking to buy a house the day after. So the builders and even any resale that's been on a market a long time, they're going to be ready to do some incentives and negotiate, right? So that's why I say don't wait, because those incentives is what gives someone like Brian, your lender, ability to work different options out for you that's best suited for you. Because people forget, even if you can buy down the rate now, or let's say you do a permanent rate buy down and it makes sense, even if you refinance down the road, that costs money. You know what I mean? So if it has to make sense. So also really quick, I know some people don't realize this. I've had some customers, I do a lot of new homes construction sales, and a lot of my customers go, there's some additional costs in closing costs for new construction. Can you touch up on that so that people aren't surprised when they buy new construction?
Yeah, definitely. So Florida is a very different there's different areas in the country where it's looked at as all closing costs, and then there's some seller obligated closing costs, and there's really even different pockets within Florida that are like that. And so Jacksonville and the surrounding counties, if you're buying new construction, most of the time it's looked at as all closing costs. So on a resale, there are some traditional seller closing costs that they typically pay, and I'll touch on those in a second. But when it comes to new construction, everything is pushed onto the buyer side, and then you generally see some larger closing cost incentives from the builders to kind of help offset that. There's, like we were mentioning with the buydowns, there's some huge closing cost incentives happening right now, just because the nature of year end and with rates being up. But yeah, generally there's going to be some additional costs that the builders will help offset some of that. But yeah, the main numbers, it can be eye-opening. I ran a quick scenario that I did a 650 sale price with 20% down, and I'm coming up with about 20,000 in costs. Now, that's every cost. So, I mean, that's also what's called prepaids, which are your taxes and your insurance, setting up an escrow account, stuff that you have to pay anyways, but that's part of that number, and it will be at your closing. So that's what it would look like on a new build at a 650 sale price. Now, if this new build were a resale and you were buying a resale for 650, there are certain costs. There's two big ones that the sellers will generally pay. is typically part of the contract. There's all these boxes that are checked, and they check mark which ones these are. And so let me just scroll through here. The two big ones, it's the owner's title insurance policy, and then there's also what's called deed stamps. And so deed stamps are any time that the deed changes hands. Well, the deed stamps alone on that sale price are about $4,500.
Wow.
And then you have owner's title, which is title insurance. And that on that sale price is $3,325. So just those two together, I'll round up a little bit, but they're almost $8,000 between the two, which is big. And then also generally on a resale, the sellers will pay for the closing attorney's fees. So they'll pay the closing, they'll pay anything else that kind of coincides with that. So those are generally the big ones. So it may be every bit of $8,500 less on a resale. So on that scenario, we're probably closer to 10 to 12,000 instead of 20 to 21,000 on a brand new builder kind of a deal.
Yeah, and that's a big difference. I think a lot of people get surprised by that. And I'm glad you broke it down on that scenario. On a $650,000 closing with a builder, you're going to pay 20 grand. And if you buy a resale, it would be maybe 12 grand or even a little less. So who knows? But that's a significant difference. So I'm glad you explained that. That's awesome for them to know that, and also for me to re-educate myself about that as well. So tomorrow I'm going to a listing appointment. I dread these listings right now, especially if it's somebody that, bought a home not too long ago and now they're having to relocate for work or whatnot. I'm always interested to see what they paid for the home and what this is going to look like in this market trying to do a resale, because I'm still competing against new home construction, right? So if all these builders are offering incentives for new home construction, you can read all the articles out there right now. Most people are buying new home construction because in the resale market, there's not a lot of inventory. And some folks are still stuck on last year's pricing, or they bought it like new construction in 2021, 2022, which is kind of the peak. Depending on the location and the home and whatnot, I have to really evaluate it to figure out what the resale is going to be. But how do I compete with the new builder down the street when I have a resale? How do I compete with them when they have incentives to buy rates down? I mean, what can I do for this listing, and what do I tell my customer tomorrow, the different options we should be offering people to entice them to look at this resale as well as the new construction down the road?
Yeah, I've actually I've had a couple past customers call me about this, and a few just general realtors call me about this, and they ask the same question. How can we compete? We're still in a home or in a community where building's still happening, and they're offering these huge incentives. They're like, can we do that too? And the answer is yes. The buydowns, I mean, the rates are a very sticky point right now. And so to have the seller, if they're able to, contribute anything towards that, it could go a long way. I mean, traditionally, there are markets where it's a seller market and a buyer market, and you always hear, oh, well, the seller will contribute, X amount towards closing costs. Well, yes, there's going to be closing costs involved, but maybe kind of tailor this a little different where, hey, the seller will give you X amount towards a rate buy down, and it may not be something that you were thinking about that could be done. I mean, to offer that kind of an incentive in a market where all the builders are doing it, well, now you can compete a little bit better. So it's definitely a good selling tool for sure.
Right. So let's say I'm listing a home for $800,000. What would be a good incentive to offer a buyer for, let's say, a rate buy down? What would that look like?
So there's the two different types, so there's the permanent and then the temporary. So the ones we talked about, the 3-2-1, 2-1, and 1-1. So again, pretty general, but if we did an 800,000, it's the buy downs are all based on the loan amount, the temporary ones. And so, so if we did a loan size of 640, this kind of gets us in the ballpark, but to do a 1 year buy down, it's about 5,000.
Okay.
And that will lower it 1% for the first year.
Okay.
So the rate's at 7.5, it gives them 6.5 for the first year of the house. So, you know, relatively inexpensive to kind of help him out or the buyer out. Saves them in that scenario $425 a month. When we bump it up and get in like the 2-1 buy downs, it jumps up pretty quick. It's about 15,000 at that point, which depending on the seller, they may or may not be able to do that depending, but it just depends on when they bought the house.
Plus you can only contribute so much as the seller. As you said before, there are percentages.
Correct. So it depends on the buyer's loan. So it's pretty safe to say that on a worst case scenario, a seller could contribute up to 3% of the sale price towards closing costs.
Okay.
And
so at 800,000, 3% is 24 grand. That's quite a bit.
Yeah.
Okay.
Yeah.
All right. That's pretty good. That gives you something to work with.
Yeah. So I mean that 24 could definitely cover the buy down, you know,
Yeah.
at 15. So I mean there's some money to work with. And then, you know, the reason the builders are showing these large incentives is they're taking the assumption that, you know, someone's putting 10% or more down, that we can hit that higher threshold, you know, but of course there's all the legal disclaimers that go along with that. So,
Yeah.
but generally 3% could go a long way, you know,
Yeah.
on that price point.
We haven't really talked about any other loans and rates or whatever. I mean, you know, I generally deal with a lot of second home buyers, and people are putting down a big chunk of change because there's a lot of people that are moving from out of state that have equity. They cashed out of their other home. They come from areas where they really have a lot of equity down. But let's talk about like FHA. Let's talk about VA. You know, those rates are looking pretty good right now too, right?
They are, absolutely. They've come down like the rest of them. I mean, I'd have to run the scenario real quick to see what VA is looking like today, but yeah, historically they're usually about 0.5% lower than what a conventional rate would be. So
Cool.
they still have the same, you know, limits on contributions. So, well, not the same, but they have limits. So FHA would be 6%. So that's just across the board. So the caveats to FHA is that there's limits to the loan amount. So they haven't announced next year's, but this year it's like 525-ish or so is the max loan you can do. So when you get above that, you're really paying dollar for dollar up to whatever that sale price is.
So if you're a VA and you're buying new construction, there's a big incentive, and VAs, you're not required to put anything down. What does that look like? I mean, you just apply it towards your closing costs and the buy down, and that's it. Can you go to the table with no money?
Yeah. So there's closing costs on every deal. And a lot of the times when someone is buying with a VA, they hear 0 down. So they're thinking, I don't need to come in with anything. So if there were no builder incentives, you're still liable for your closing costs. But if with these builder incentives, you legitimately could come in and not owe a dime. So, and in fact, you get money back because a lot of them take the binder deposits to hold the property. So if you gave the builder $10,000 to hold the property, you would show up and get your house and a $10,000 check back. So, so yeah.
So VA loans have a lower interest rate, and you can use incentive money to buy that down even more.
Correct.
So man, if you're a VA right now and there's these massive incentives, and you don't even need a lot of cash, but if you're looking at the right home and you're in a situation where you need a home, there's some great opportunity right now, even more so for you with those kind of rate buy downs.
Oh, absolutely. I mean, you could get you can get very low on VA for sure.
Wow. Okay. Cool. I didn't think of that because I'm like, people always shun away from VAs. I think they're fantastic. I mean, on resales on older homes, it's always been, well, you know how it is getting a appraisal and a VA loan to pass on a resale. But on new construction, it's actually a great idea.
Oh yeah.
Yeah. If
Yeah.
you have opportunity.
Yeah. If you're VA eligible, then it's a great loan to look at. The only time, now, like you mentioned, it's 100% financing, but the only time that sometimes this wouldn't be good is if you were going to put a bunch of money down. VA, they have what's called a VA funding fee. And so it's just a fee that VA charges so that you could use their loan. And sometimes people are exempt from that fee. So, for example, and it's all based on any VA disability that you may have. So generally, if you're 10% or more disabled in the eyes of the VA, you'd be exempt from the funding fee. So for example, if you did a sale price, let's say a 500,000, and you've never had a VA loan before, the VA funding fee would be almost $10,000. So it's not cheap. It's nothing you pay out of pocket. It's financed into your loan. But sometimes if someone has a very large down payment, sometimes it is better to look at conventional, just because then you'd avoid having to pay that VA fee. But again, everyone's scenario is different. This is something we thoroughly explore just to make sure we got the right program for you.
Great. Oh man, Brian, this is exciting. I love just, opening people's minds up and giving them some encouragement, because there are still a lot of people sitting on the fence waiting, and this is actually the time to attack. So if you have that ability, of course, no one should be purchasing a home if they're financially in dire straits, or there's a lot of instability with jobs or whatnot. But if you are sitting on the fence, or you're paying endless amounts of rent, there are a lot of options for you. I also have a lease satisfaction program, especially if you're buying new construction. So if you're looking to buy new construction and you're stuck in a lease in Florida, there are a lot of options for satisfying and getting out of that lease early. So that's another option that I'm offering as well as a broker. So a lot of options out there. Brian, I appreciate your time. Is there anything else am I missing anything today that I need to bring of value to my customers and people watching today?
No, I think we hit a lot of things. I guess I would say that the most important thing is to talk with a loan officer about your options. There are a lot of options out there, and it would help you come up with a good game plan going into everything, so you know exactly what you're getting into. But,
yeah, absolutely. I always tell my people, call 2 or 3 lenders and get a loan estimate worksheet to compare numbers and be advised properly by someone who's been in the industry a long time. And I obviously, I don't just refer anyone. There's a lot lenders like Brian that I only work with because I trust, you've been in the business over 10 years. You're not like, I always say, I'm not one of those hungry realtors where I'm like, this is a long-term business and we want to do what's right for you. So this is free advice and consultation for you to call, even if you're thinking about next year or, 6, 9, 12 months from now. You should be talking to a lender like Brian now to look at your situation now. So if there is anything that you need to prepare for, he can advise you with that, whether it's credit, debt, just strategizing, job changes, or anything. It's always smart to talk to someone now so that you can plan better for the future. Am I right?
Yep, 100%.
Cool. I'm going to have your information in the description below, as well as mine. If you're thinking about moving in the area or you're looking to sell your home, make sure you holler out. Information will be in the description below. It doesn't matter if you're moving 9 days, 90 days, 180 days. It does not matter. Call a professional, whether it's a professional lender like Brian or it's a professional broker like myself. I'm Greg DeTullio. It's Brian Jacobs. Our information will be in the description. Thanks for watching, and I'll see you on the next video.